We are watching something happen in real time in the US stock market right now. And if you are holding positions in data center infrastructure, or you've been watching from the sidelines trying to figure out when to move, you need to be paying close attention to what is unfolding today. Equinix, ticker EQIX, and Vertiv Holdings, ticker VRT, are at or near record highs. We are talking about two stocks that are leading one of the hottest sectors in the entire market right now, and the numbers coming in are moving fast. Let's get right into it. Equinix hit a new 52-week high of $1,016.39 on April 7, 2026. The stock closed the previous session at $1,000.37. That is a four-digit stock price, and the Wall Street analyst community is not backing down from it. In fact, they are raising targets. JP Morgan just moved its price target on EQIX to $1,100. Stifel raised its target to $1,075, up from $1,020, maintaining a buy rating. UBS moved to $1,010 from $950, also buy. HSBC is sitting at $1,050. Out of 29 analysts currently covering this stock, the breakdown right now is 4 strong buys, 18 buys, and 6 holds. Nobody is calling this a sell. The average 12-month price target on EQIX is sitting in the range of $896 to $1,118, depending on the firm. The high end, Cantor Fitzgerald, has an overweight rating and a $1,173 target. That is still meaningful upside from where the stock is trading right now. Now let's talk about what is actually driving this move, because this is not a story about speculation. This is a story about earnings and bookings that are coming in exceptionally strong. Equinix just posted its Q4 2025 results. Full year 2025 revenue came in at $9.217 billion, up 5% year over year as reported, 6% in constant currency. But the number that really got Wall Street's attention was bookings. Q4 annualized gross bookings hit $474 million. That is up 42% year over year. Full year bookings for 2025 came in at $1.6 billion, up 27%. Monthly recurring revenue in Q4 was up 10% year over year. Adjusted EBITDA for the full year landed at $4.530 billion, representing a 49% margin and 11% year-over-year growth. And when Equinix issued its 2026 full-year guidance, revenue of $10.12 billion to $10.22 billion, which is 9 to 10% growth and ahead of where analysts had modeled it. Shares surged 10.4% in a single session. 10.4% in one day for a company with the market cap currently sitting at approximately $94 to $101 billion. That reaction tells you exactly how hungry this market is for data center infrastructure names right now. And there is a catalyst here that goes beyond the headline numbers. Equinix just made its biggest acquisition move in years. A $4 billion deal for atNorth, a Nordic data center provider specifically targeting European AI infrastructure expansion. This is Equinix executing directly on the AI demand thesis in real time, deploying capital into a geography where AI data center supply is extremely constrained relative to demand. The company is also reporting that AI workloads are now driving 60% of its largest deals. That is not a marketing figure. That is coming directly from management commentary on earnings calls. 60% of the biggest bookings Equinix is closing right now have AI as the primary demand driver. Q1 2026 earnings are scheduled for April 29th. Analyst consensus is currently modeling Q1 revenue of approximately $2.51 billion and EPS of $6.44 to $6.54. The Street is watching those numbers closely. Given what bookings looked like in Q4, there is a real expectation that Q1 comes in strong. Now let's talk about Vertiv, because this stock is operating in a completely different category of price movement. Vertiv hit $297.52 on April 10, 2026. Its confirmed all-time high on an intraday basis is $282.05, reached on March 24, 2026. Depending on the session, this stock is trading at or above that level right now. The 52-week range on VRT currently stretches from $53.60 on the low end to $297.56 on the high end. Read that again, $53.60 to $297.56 in 52 weeks. That is a stock that is nearly quintupled. And here is the catalyst that pushed this into a new gear. Vertiv was added to the S&P 500 effective March 23, 2026. That is a structural event. S&P 500 inclusion means every index fund, every passive investment vehicle, every ETF that tracks the S&P 500 is now required to hold Vertiv. That is forced buying. Billions of dollars in index-driven demand flowing into the stock at the moment of inclusion. The announcement came on March 6th, when the stock was trading at $241.72. It went to nearly $300 in the weeks that followed. But the S&P 500 inclusion is not the fundamental story. The fundamental story is the earnings, and those numbers are genuinely striking. Vertiv's full-year 2025 net sales came in at $10.2 billion, up 27% year-over-year. Net income hit $1.3 billion. That is up 169% year-over-year. Q4 2025 alone posted $2.88 billion in net sales, up 22.5%, with net income tripling year-over-year in that single quarter. And the forward guidance is what is really keeping investor attention locked in. Vertiv has guided 2026 net sales of $13.25 billion to $13.75 billion. That is another 27 to 29% of top-line growth on top of an already exceptional 2025. Adjusted EPS for 2026 is guided at $5.97 to $6.07. The company is telling the market the demand is not slowing down. The order book supports this trajectory, and we expect to grow at this pace again. Q1 2026 earnings for Vertiv are coming before market open on April 22nd. That is right around the corner. Analyst consensus is currently modeling Q1 revenue at approximately $2.63 to $2.645 billion. This is a critical print. Given the stock's trajectory and valuation, this is one of those earnings reports where the reaction on the day could be significant in either direction. The market is going to be watching VRT's organic orders growth number in particular. In Q4 2025, Vertiv reported organic orders growth of 25.2%. If that number holds or accelerates in Q1 2026, you are looking at further upside momentum. If it shows any sign of slowing, that is where the conversation changes. The reason both of these stocks are doing what they are doing is the same reason, and it is not complicated. The largest technology companies in the world are spending money on data center infrastructure at a rate that has no historical precedent. Here are the current numbers. In 2025, Microsoft, Google, Amazon, and Meta spent a combined $388 to $416 billion in capital expenditures, the vast majority directed at data centers and AI infrastructure. Microsoft, approximately $90 billion. Google, $91.4 billion. Amazon, $125 billion. Meta, $72 billion. That collective figure was up 66% from 2024's combined CapEx of roughly $251 billion. And 2026 is projected to be larger. Current estimates from analysts and infrastructure research put combined hyperscaler CapEx for 2026 at $600 billion to $750 billion. Amazon is projected at approximately $200 billion. Google at $175 to $185 billion. Meta at $115 to $135 billion. Microsoft at $110 to $120 billion. Goldman Sachs has flagged that the number could push towards $700 billion or beyond if historical tech infrastructure cycles repeat their patterns. Roughly 75% of 2026 hyperscaler spending is projected to be tied directly to AI, not traditional cloud services, not legacy infrastructure maintenance. AI. That means data centers are being redesigned, rebuilt, and expanded specifically for AI workloads. And that redesign requires exactly what Equinix and Vertiv provide: the physical space, the power infrastructure, and the thermal management systems to run high-density GPU compute at scale. The global AI data center market is currently valued at $17.73 billion. Projections put that number at $133.51 billion by 2034, a compound annual growth rate of approximately 26%. U.S. power demand from AI data centers alone is projected to grow more than 30 times by 2035, reaching 123 gigawatts. This is the macro backdrop that both EQIX and VRT are operating inside of right now. This is the current environment, and the stocks are reflecting it. On Equinix, the stock is trading at a PE ratio of approximately 65 to 75 times earnings. The peer average for specialized REITs is 28.6 times. That gap is significant, and it is the reason that even with a moderate buy consensus, some analysts are flagging concern. Scotiabank just downgraded EQIX to sector perform from outperform with a $1,050 target, citing valuation as the primary concern. Morningstar currently has EQIX trading at an 88% premium to its internal fair value estimate of $884. At the same time, Equinix carries approximately $22 billion in debt, the cost of building and operating 273 data centers across the globe. That debt structure is manageable given the recurring contractual revenue profile of the business, but it does create interest rate sensitivity. If the macro environment shifts toward higher rates, the cost of servicing and rolling that debt becomes a meaningful factor in the earnings picture. There is also the Q4 2025 earnings miss that is still in recent memory. EQIX reported Q4 EPS of $8.91, which actually beat estimates of $5.38 by 65% when measured that way. But earlier in the year, there was a quarter where EPS came in at $2.69 against a forecast of $3.71. That kind of miss on a stock priced for near perfection is what keeps some analysts at hold rather than buy. On Vertiv, the valuation debate is even more acute. VRT is currently trading at a normalized PE ratio of approximately 62 to 87 times earnings, depending on the source and measurement period. Morningstar currently rates Vertiv at a 147% premium to its internal fair value estimate. That is a significant flag from a firm that is generally considered to be methodical and conservative in its fair value work. A discounted cash flow model under bearish assumptions, slower hyperscaler growth, margin pressure from competition, any execution miss, puts Vertiv's fair value at approximately $155. Against a current price in the $280 to $297 range, that is roughly 40 to 47% downside if the growth thesis gets disrupted. The specific risks analysts are flagging on Vertiv right now are: 1. Any signal of hyperscaler CapEx deceleration in the second half of 2026. If that happens, Vertiv's earnings multiple could compress rapidly toward 30 to 35 times. 2. Margin pressure. Vertiv's EMEA segment has already seen 710 basis points of margin contraction, which is a data point the bulls need to explain. And 3. The April 22nd earnings print itself. Analysts note that if Q1 organic orders growth comes in below the guided 27 to 29% trajectory, the stock could gap lower 10 to 15% in the session. Let's go to the current operational numbers on Equinix, because these are the numbers the market is responding to. Equinix's Q1 2026 revenue guidance is $2.496 billion to $2.536 billion. That is the range management has told the market to expect, and analysts are currently at approximately $2.51 billion in their models, essentially in line with the midpoint. The interconnection business, which is the higher margin, higher moat segment, posted $422 million in revenue in Q3 2025, up 10% year over year. That segment is growing faster than colocation, and it matters because interconnection revenue has a network effect built into it. The more companies co-locate in Equinix facilities, the more valuable the ability to connect directly to those companies becomes, which attracts more companies, which increases the value again. That dynamic does not erode easily. Equinix's xScale program, its large-format wholesale data center offering targeting hyperscalers directly, currently has more than 400 megawatts leased. This is the product designed specifically for the Microsoft, Google, and Amazon-level demand. And given that hyperscalers are projecting $600 to $750 billion in combined CapEx in 2026, the demand pipeline feeding into xScale is substantial. The company's churn rate remains at 2 to 2.5% annually. That number tells you something important about stickiness. Once a company is inside an Equinix facility, connected to dozens of other companies and cloud providers in that ecosystem, leaving is extremely operationally complex. That low churn is what supports the recurring revenue model and justifies the REIT structure. Equinix has now posted 22 consecutive years of quarterly revenue growth. It raised its dividend 10% this year, the 10th straight year of dividend growth at that rate. The annual dividend currently sits at $19.23 per share, yielding approximately 1.86 to 2% at current prices. Vertiv's Q4 2025 organic orders growth came in at 25.2%. That is the number that tells you the pipeline is real, and it is building. Orders today become revenue tomorrow. And 25% organic orders growth means Vertiv is still accelerating into 2026, not plateauing. The company operates across more than 130 countries, making it a truly global infrastructure supplier. Its power management products, UPS systems, high-voltage DC architectures, lithium-ion battery backup systems, and its thermal management products, liquid cooling distribution units, rear door heat exchangers, indoor chillers, are being deployed at scale into AI data centers across the US, Europe, and Asia. The liquid cooling segment is the one getting the most attention right now, and for a clear reason. Hyperscalers are not just building more data centers, they are building fundamentally different data centers, ones where every rack is running AI GPUs at power densities that air cooling physically cannot handle. Vertiv's liquid cooling systems are rated at efficiencies up to 3,000 times more effective than air. That is the engineering advantage that is driving order growth. On the margin front, Vertiv's Q4 2025 operating profit was $457 million, up 60% year over year. Full year 2025 net income of $1.3 billion was up 169%. The margin expansion story is happening, but it is happening unevenly. The EMEA segment's 710 basis point margin contraction is a data point analysts are actively watching. Management has attributed this to regional pricing dynamics and supply chain complexity in that geography, and the company maintains that the overall margin trajectory is upward. The 2026 adjusted EPS guide of $5.97 to $6.07 reflects an assumed continuation of that margin expansion. If Vertiv delivers on that range, the forward earnings multiple compresses, and the bull case becomes more defensible at current prices. Here is what is happening at the institutional level in real time. On EQIX, 75% of covering analysts currently have a buy rating. 21.9% are at hold. Only 3.1% have a sell rating. Zacks recently upgraded EQIX to a rank 1, its strong buy category, citing rising confidence in the Q1 2026 earnings outlook ahead of the April 29th print. The institutional positioning on EQIX reflects a market that broadly believes in the data center co-location thesis, but is not without internal disagreement on how much premium to pay for it. On VRT, the analyst consensus is also heavily bullish. 47% of covering analysts are at strong buy, and the overall rating is consensus buy. But that 47% strong buy figure exists alongside a 6% strong sell. which for a stock of this size and profile is a wide divergence. The disagreement among professionals on Vertiv is genuine and reflects the binary nature of its risk-reward at current valuations. The broader market context matters here as well. The S&P 500 went through a challenging Q1 2026, down 4.63%. The Nasdaq was down 7.11% in Q1. Technology as a sector was down 7.57%. But industrials, which is the sector classification where a lot of data center infrastructure spending flows through, was up 4.55% in Q1 and up 16% year-to-date through February. The market is actively rotating into the physical infrastructure side of AI and away from the pure software and semiconductor plays that ran hard in 2024 and early 2025. EQIX and VRT are benefiting from exactly that rotation. Investors who are nervous about pure AI software valuations are moving into the companies that physically build and power the facilities those AI systems run on. It is a flight to tangibility within the AI trade. There is one current market dynamic that is not getting enough attention in the day-to-day stock coverage, and it is directly relevant to both EQIX and VRT. Power availability is becoming the binding constraint on new AI data center construction in the United States. U.S. power demand from AI data centers is projected to grow more than 30 times by 2035, reaching 123 gigawatts. Utility capital expenditure jumped 22% year-over-year to $212 billion in 2025 in response to this demand. But grid permitting, interconnection queues, and construction timelines are running 3 to 5 years in many jurisdictions. What this means for Equinix is that existing facilities with secure, contracted power supply become more valuable. New supply cannot come online fast enough to meet demand, which means the utilization rates and pricing power at Equinix's existing campuses go up. The scarcity of build-ready, power-secure data center space is a tailwind for an incumbent like Equinix that already has the power contracts in place. What this means for Vertiv is arguably even more direct. The reason liquid cooling is becoming mandatory is not only about AI compute density, it is about power efficiency. When energy availability is constrained, every kilowatt per rack of efficiency improvement matters. Vertiv's liquid cooling systems are dramatically more energy efficient than air cooling. The tighter the power supply gets, the stronger the argument for Vertiv's products becomes. Right now, there are two imminent catalysts that every investor in this space needs to have on their radar. April 22nd, Vertiv Q1 2026 earnings. Before market open, this is the first major test of the 2026 guidance. Analysts are modeling approximately $2.63 to $2.645 billion in Q1 revenue. The organic orders growth figure is the key metric. If that number holds at or above the 25% range seen in Q4 2025, expect the stock to react positively. If there is any deceleration in orders, particularly from hyperscaler customers, the market will respond fast, and the move could be significant. April 29th, Equinix Q1 2026 earnings. Analysts are at approximately $2.51 billion in revenue consensus and 6.44 to 6.54 in EPS. The bookings number is the one to watch here. Equinix's Q4 annualized gross bookings of $474 million beat every prior benchmark. If Q1 bookings sustain or exceed that level, the stock has room to run toward and potentially through the $1,100 price target range that JP Morgan and others are currently publishing. Both of these prints are landing in a market that is already running elevated expectations for data center infrastructure. That means the upside on a beat is real, and the downside on a miss or a guidance cut is equally real. These are not low volatility events. Position accordingly. Here is where things stand right now. Equinix is trading at approximately $959 to $1,016, near its 52-week high. The analyst community is 75% buy. 2026 full-year revenue guidance is $10.12 billion to $10.22 billion, representing 9 to 10% growth. Bookings are at record levels. AI is driving 60% of the company's largest deals. Q1 earnings land April 29th. The stock is expensive by traditional REIT metrics, and that valuation debate is live and ongoing on Wall Street right now. Vertiv is trading near $295 to $297 at or above confirmed all-time highs following S&P 500 inclusion in March. 2026 net sales guidance is $13.25 billion to $13.75 billion, 27 to 29% growth. Organic orders were up 25.2% in Q4. Net income grew 169% in 2025. Q1 earnings come April 22nd. Valuation is stretched by almost any conventional measure, but the underlying demand environment, $600 to $750 billion in projected 2026 hyperscaler CapEx, mandatory liquid cooling for AI compute, is as strong as it has ever been. The market right now is telling you that whoever owns, powers, and cools the physical infrastructure of the artificial intelligence economy is worth paying a premium for. The stocks are reflecting that belief. The next 2 weeks of earnings will tell us whether the execution is keeping pace with the expectation. We are watching both of these very closely. Stay with us.